Q1 earnings season has officially landed, guys, with this past week seeing some very big popular stocks reporting. And in today's video, we're going to do a quick recap and review of the ones from Tesla, Netflix, Bank of America, US Bank, and a few more. So let's take a look at how they did, how the market reacted to them, and of course, I'll give you my own personal thoughts on each of them too. It's going to be a fun one. Hope you enjoy it. Let's jump straight into it. Okay, now Tuesday and Wednesday really had the most popular stocks reporting, so I'll just focus on those this week. We'll do a closer look at Bank of America, Netflix, Tesla, and US Bank, which by the way, USB is my newest stock that I've actually been buying recently myself. But then after that, we'll also do just a really quick rapid fire of also Johnson & Johnson, United Airlines, and a couple more banks in Ally and Morgan Stanley. But if you want to jump around to any of these specific stocks, I'll leave you chapters down in the time bar so that you can skip around in the video. But starting first here with the second largest bank in the US, that's Bank of America, ticker symbol BAC. And this report here for earnings was highly anticipated because, of course, of the recent collapse of some large banks, including Silicon Valley and Signature Bank, which mostly had to do with poor leadership decisions, but was also kicked off and made worse by the horrible macroeconomy, as well as the sharp rise in interest rates that really devalued some of their investments and helped lead to their failures, which of course in turn led to more fear and panic that other banks may be facing similar issues too. So all eyes were really here on Bank of America as the second largest bank. But for being such a big sized, large sized bank, they actually reported some pretty strong numbers here that were in many ways boosted by those rising interest rates that helped their loans collect more interest from customers. The CEO also pointed out that every business segment performed well as they grew their clients' relationships and accounts organically and at a strong pace, which is something that I've been saying too recently, is that don't be surprised if the collapse of SVB and other smaller competitors actually leads to an increase in business for some of the bigger giants that customers trust a lot more because they're larger, they're more heavily regulated, and they're just much less likely to fail. And that's what we saw this quarter, with checking accounts actually growing by 0.13 million quarter over quarter and 1.3 million year over year, which the CEO pointed to this as well, saying we're pretty confident that we saw a noticeable flight to safety. And all of this really led to them easily beating analyst estimates on both the top and bottom line. However, if you look at the stock, it actually just barely climbed by around 1% this week, and it actually fell in each of the 3 days following the earnings report, which was a little surprising to me. My guess is that it has to do with net deposits actually declining slightly in the quarter by around 1% and closer to 8% year over year, which tells me that people are probably just moving their money out of low interest bank accounts and instead putting it in money market funds where they can get higher yields right now. Yes, there might be more customers, but not as much money being deposited there and actually being put somewhere else. They might even be putting it in fintech. Like, why would you put your money in a Bank of America savings account that yields almost nothing when you can go to SoFi, which is a fintech, and you can get 4% on it, on your money, and it's even FDIC insured. So I just think BAC isn't really doing enough to attract more deposits. But regardless, I still think they're more than healthy at this point with growing accounts and superior size and strength over much of the competition, despite trading at about the same PE ratio as the sector and paying out a 3% dividend yield with some excellent growth metrics on it too. So probably a good long-term buy at this point, but you guys know that I still prefer Chase and US Bank more myself. Up next though, we had the streaming giant Netflix report, ticker symbol NFLX, and this one was a bit of a mixed bag. While they did slightly beat on EPS numbers by 2 cents, they actually missed on revenue, only growing it by less than 4% year over year. And they also missed on paid subscriber growth by around 450,000, which sent the stock falling over 3% this week. This also comes at a time when those subscriber numbers have been mostly plateauing here at the top, while competitors continue to gain ground on them. Disney, for example, has already surpassed them with over 235 million streaming subscribers, while Amazon already reported over 200 million Prime members, and that was 2 whole years ago, which of course includes Prime Video in that membership. To be fair, Netflix has been doing everything they can to grow their numbers again, like expanding further internationally, which is where they see almost all of their growth these days, especially in Asia. And they also recently launched a cheaper ad-supported version to their plans that starts at only $7 a month to help attract lower income users. However, those plans can quickly get expensive, reaching $20 for the highest quality. And while the stock is down huge from the over $700 share price that they used to trade for, the valuation is actually still pretty ridiculous even here at the low 300s. I mean, you could get the much larger and more diversified Disney for less than half the price to sales ratio and still much cheaper price to earnings to growth ratio as well. Next quarter, Netflix is also guiding for less than 4% revenue growth again, and overall, I just think owning Disney or Amazon stock is a much better choice with just as much exposure to video streaming as Netflix, but they're much larger, more diversified. But I might be biased because I do own those two myself. Next up, though, we had Tesla report on Thursday, ticker symbol TSLA, who actually suffered a pretty big hit this week, falling by over 10%. Although they are still having a pretty good start to the year with over a 30% climb year to date. From the top though, Tesla is still pretty heavily beaten down, having lost well over half its value. And when looking at earnings, it's not a pretty picture either, with net income profits actually crashing by over 20% in the quarter. Elon Musk noted that the fall in profits has to do with underutilization of new factories, stressed margins, higher raw material, commodity, logistics, and warranty costs, all of which is happening during a rising interest rate environment where the macroeconomy is in really bad shape, going on to say that he expects about a year's worth of stormy weather in the economy, and that every time the Fed chooses to raise interest rates, they essentially increase the price of their cars for consumers. And that's that because of it, in this weakening economy, consumers are going to be less likely to make big new capital purchases like, buying a premium vehicle like a Tesla. With that said, though, sales still rose by 24% year over year and actually beat analyst estimates too. Tesla is also selling just about every vehicle they can make right now, and Musk confirmed that their plan is to still prioritize the increase of their production capacity versus doing lower volumes with higher margins, noting that profits will still grow much higher over time as they gradually shift towards autonomous technologies. And I do agree with that myself. I own Tesla stock, and I think that the superior margins and profits will come and grow over time. Right now, you got to focus on meeting demand. You have the new Cybertruck starting deliveries later this year, which Musk confirmed in the earnings call that it will be coming later this year. And you just launched the Semi last year. These are vehicle guys that I think you can probably sell as many as you can build of them. And we know that Tesla wants to reach vehicle deliveries of 20 million by 2030. So you have to ramp up production as much as possible. Now, right now, Musk stated that they'll do around 1.8 million in production this year, with the possibility of doing more than that if possible, maybe reaching 2 million. But to reach that 20 million goal that they have, you're probably going to have to be growing deliveries by around 40% a year. And even if they do half of that, though, I would say that the stock's valuation would grow much higher from here because of their superior margins. And that's just vehicle sales that we're talking about. I think that they can actually supplement that growth that they need with more autonomous revenues from a robo-taxi service, or they can ramp up energy too. Keep in mind, this quarter, they actually grew their energy segment by almost 150% and turned it into $1 billion business, with energy storage deployments also rising by 360% as well, which is a great sign. And while sales are only growing by around 20 to 30% right now, the fact of the matter is that the economy is trash. Tesla is busy investing in new factories to ramp up production, and at the end of the day, we've seen Tesla have some spectacular years of growth out of nowhere at times, just like they did in the past 2 years at over 70% and 50% respectively. So right now, I feel that the stock is probably fairly priced at a PEG ratio of less than 1.5, and that's with analysts only expecting a 10% increase in EPS over the next 5 years on average. I think they're heavily lowballing that, and I think that both the sales and especially the margins will improve over time. So I'm holding on to my shares for the long term. All right, and then after that, we also had US Bank Corp, ticker symbol USB, report earnings, which is actually my newest pickup in my portfolio that I just started buying myself. And they fell by another 4% this week in a move that makes very little sense to me. It actually started off strong, but in the 2 days following the report, it just started falling once again. But this now leaves them at what I feel is a fantastic price. I mean, you're talking about them losing almost half their value from the top and now trading at about the same price as that huge crash you saw in 2020 and literally the lowest price that I've seen in over a decade in the stock. Yet they're one of the biggest banks and they actually trade 10 to 15% cheaper than the sector on a forward PE basis. Plus, the dividend has now soared to almost a 6% yield, marking the highest level that we've seen in that dividend since the Great Recession. Granted, they did cut it during that time, but ever since then, it's been growing every year, and it still has a solid payout ratio and even a pretty high growth rate to go along with it as well. Now, obviously, the stock crash has a lot to do with the recent banking crisis, but in my opinion, US Bank is doing just fine. They're more of a slow-moving, kind of boring bank that I feel makes them more consistent and maybe a little safer. That with the new acquisition of Union Bank, they're only going to get even larger with 17% revenue growth expected this year. Yet, like I said, they actually trade significantly cheaper than the sector, which brings me to the earnings report. Not only did they beat on sales with 7.18 billion reported versus 7.12 billion expected, and not only did they beat on EPS with 1.16 versus 1.12 expected, but they also saw a significant increase to both deposits because of that migration to safer banks during the bank crisis. So USB is actually benefiting from both rising interest rates and all of the bank fear, and yet the stock went down. It doesn't really make a lot of sense. I guess it could be that investors are just kind of worried about the deteriorating economy overall, which would obviously crush banks. If we have a recession, people can't pay back their loans, things like that. But at the moment, the stock does look fairly cheap to me here. And when I looked online, it seemed like everyone was kind of scratching their heads too. Lots of comments out there saying that it doesn't make sense for the stock to be falling post earnings. And a lot of people were just kind of asking why it's down and saying that they can't really find any reasons for it online. But in any case, USB stock is the only one on today's list that actually trades significantly lower than even the lowest analyst price targets. And I'm going to keep buying the stock in small amounts myself as long as it trades this cheap. All right, guys, I'll just finish up here really quick with the other stocks. We'll just do a super fast rapid fire of these. But we had the consumer staple and pharmaceutical giants Johnson & Johnson do very well, beating on both the top and bottom line, with even a raise to their full-year guidance. And the CEO noted strong performance across all three of their business segments, which of course includes their consumer health segment that is now being spun off to make J&J a more growth-oriented company moving forward. Surprisingly, though, the stock actually fell about 2% and is still down about 8% year-to-date. So it may be worth picking up soon, considering that 6-decade-long dividend history with almost a 3% yield. It's very attractive. We also had a few more banks report, like Ally Financial, who actually missed on both the top and bottom line, sending the stock falling close to 4% this week. I've never really been a fan of Ally myself, to be honest. And then we had Morgan Stanley also report, who actually beat easily on both the top and bottom line, sending the stock rising by over 5% this week and leaving it up over 7% year to date at a time when most banks and financial stocks have actually been falling. So pretty impressive there, showing a sign of strength really in Morgan Stanley, but I've never really been interested that much in the stock there myself either. And finally, I'll just mention a major airline that reported in United Airlines, ticker symbol UAL, who posted a loss this quarter, But it was at least a beat on both the top and bottom line, since analysts were expecting even worse performance. And that actually sent the stock climbing by almost 7% for the week and leaving it up close to 20% so far this year. I really want to make an airline stocks video soon because these are starting to look really interesting now. They crashed heavily in 2020 with the pandemic. You can see United's financials here just plummeting that year. But ever since, they've been growing to what looks like a record high, at least for sales. So I really need to make a video on these soon and do a deeper analysis on them. But that'll do it for this week's earnings update, guys. Let me know what you think about all of these down below in the comments section. And make sure you tune in next week because we're going to have some even bigger tech giants reporting, including Microsoft, Amazon, Google, and Meta, and more, and I'm gonna review those for you as well. So make sure you catch that video, make sure you're subscribed. Thank you for stopping by, everyone. I hope you're all doing well. I'll catch you in the next video, my friends. Take care, everybody. Bye-bye.